one of the things that I've been doing is educating people on how to do this. So what I've learned is you can actually get an edge on analyzing these mining stocks if you know what you're doing. And I wrote a book. So the combination of this slideshow and my book will help you to analyze these mining stocks. We only have a short period left. We have about, I would say about 6 months, maybe 9, to buy stocks on sale because we're in a bull market. So it's not going to be long. These stocks are all going to get pricey. So let's go ahead and do this presentation. So I wrote a book. First thing I did, the 12th edition just came out. It's a very thorough book, and it literally teaches you how to analyze these mining stocks. Then I created a website, and my website has about 850 gold and silver mining stocks. And it's very useful because I rate all these stocks. So you can see, does Don like this stock? I give it a rating. I put it in a category, give it a risk level. So there's there. Then I help people on X. So I have 85,000 followers on X, and I spend a lot of time on there answering questions. Continue doing that. Okay, there's 3 pieces to this presentation. The first piece is producers. And then we'll do developers, and then we'll do exploration. So for each group of stocks, I've come up with a methodology, if you will, on how to find a stock that gives you an edge. The first one is the producer's checklist. The first thing is properties. So you want to find a producer that has quality properties. And so the grade, the recovery rate, the mine life, the economics. And checklist number 1, I like to rate these from like 5 to 10, but generally you don't give it a 10. So it's like 5 to a 9. And so each one of these, you want to find companies that have like 7, 8, 9s for each number. And if you can find that, then there you get your edge. Second one is location issues. So again, we're kind of rating these companies from like 5 to 9, 9 being best. After you do it a few times, you'll get a good handle on it. The next one is financing issues. This is mainly for companies like they did a bad financing and now they have to pay a gold stream and it's hurting their profits. So you want to look out for that. Management team. With producers, it's all about execution. So you're not going to really learn about a management team until they've been in production for, a year, 2, 3, and you start to get a good feeling. They have a track record, if you will, and you're always looking for really good teams, especially with producers. The next one is valuation. So you don't want to buy a pricey stock. Right now, we really don't have any pricey stocks. Even Agnico Eagle is probably a 3-bagger right now, which is probably the most, Lundin, the upper echelons are probably 3-baggers. So we really don't have any 1-baggers yet. So it's still early. So right now it's still possible to find producers that have good valuations. The next thing is the balance sheet. I want to find companies that are cash focused. You don't always find that. When I say cash focused, I mean that they only have cash on their balance sheet. They don't have any debt. Ideally, I like to see a company that has at least $100 million in cash and no debt. That's a real strong balance sheet. Cost margins. So right now, the producers, all of them, gold and silver producers, have very good margins. It's pretty stunning. The silver miners have actually passed up the gold miners on a percentage basis. Who would have thought that? Early August this year, they had very low margins. Now they have high margins. It's very impressive. So the margin's pretty easy to find them today. Then you want, ideally, you want a producer that has growth. They have some type of a pipeline. Producers that don't have a pipeline, they have no production going, they're going to have a hard time getting a real high multiple. The companies that have something that they're working on, that they have production growth, then those companies are going to be more valuable. The next one is a share structure. This isn't as important for producers as it is for developers, but it can be. It's always nice to have a tight share structure. And the last one is kind of your overall risk reward. So we kind of look at all 9 of those factors, and we try to basically judge the overall risk of a company. And again, if you put a rating, 5 to 9 for each of these 10 items, if you can find a company that 7, 8, 9s on all of them, you're looking at a good company, and you have an edge. The only thing that you need, if you can get all 10, if you will, is the price of gold or the price of silver. If that's the only factor that really is going to make an impact, you have a really strong edge. So I'm thinking I'm going to make 80% of my profit from producers. So I want to own as many producers as I can, but I don't want to overpay. And that's what I try to do. So I own a lot of developers who turn into producers. All of these companies are developers of one. And so I'm always looking for developers that are going to turn into producers. And I think all these companies that are on this panel will turn into them. Okay, those are producers. The next one is the developers, and it's a shorter list, but ironically, even though it's shorter, it's actually more important because developers have more risks than producers. So the first one is similar to the producers, where I talked about strong properties. This one I'm talking about projects, because they're building their first project. The developer is not a producer. They're developing their first project. Generally, they could be restarting. They could have stopped and started. And so we're looking for strong projects. This is something you have to learn over time. You will learn, what is a strong project and what isn't one. A lot of times it comes down to economics. What is the CapEx versus the MPV? You always want one that has an MPV that's like 2x the CapEx, 3x the CapEx. Once in a while, you find them bigger than that, but you're looking for very strong projects, long lives, really good economics. The next thing is very high upside potential. Developers are going to dilute their shares. It costs a lot of money to build these mines. So we're looking for projects that I want to start with at least a 10-bagger. When I say a 10-bagger, I'm not using today's gold price. I'm using future gold prices. Right now, I'm using $6,000 gold, $100 silver, which I think is a little too conservative. Right now, I'm really think I should use 6,500 and 150 silver. But good location. This is same with producer. Ideally, though, with the developer, you want to find a project that's in a mining district. That's usually, if a project's in a mining district, the odds of it getting built are very good. Or it could be a mining-friendly country or a mining-friendly state, but locations are important for developers. Also, each one of these items I want to rate from 5 to 9. I want these to all be 7, 8s, and 9s. Strong management team, especially you want past experience, a good team and a good board. This is something you learn. It takes a while to get a good feeling for the overall team. You learn this doing one-on-ones with companies. You do this watching CEOs do their presentations. But this is where, on these development projects, a lot of times this is where we take a little bit of a risk, because the management team, if they're not currently a producer, if you will, and they're trying to build their first mine, a lot of these teams are not necessarily, have a lot of experience. That's the reason, they're building their first mine. A lot of them are, we see a lot of young CEOs, if you will. And so sometimes it can be very difficult. This is one of those ones you kind of take a bit of a risk on, a little bit of a gamble on, sometimes these management teams. But if the project's strong enough, I have no problem taking risk on developers. That's what developers are. Developers are high risk. The next one is the one that is probably giving me the most trouble is, does the company have a path to production? And I get really excited when CEOs are passionate about their projects and they're passionate about their plans. And so what I've done in the past, I've invested in developing companies that didn't really have a strong path to production. And they've disappointed me. So that one is very important. The last one, there's only 6 on there, is a strong insiders. Because if companies don't have strong insiders, they tend to get taken out either before they build the mine or shortly after. Now, there's only 6 items here for these developer checklist. You need all 6. If a developer doesn't have all 6, you pass, move on to the next project, because developers will just break your heart over and over again because they tend to have very high upside. And if a company is going to have very high upside, we're talking 10 baggers, it all has to fall into place. I've just found that you just need all 6 of these. And if they don't have all 6, just pass. And I want to own as many undervalued producers, as many developers that check all the boxes as I can get my hands on. I'm somebody that, I buy lots and lots of these stocks. I just want just this huge bucket of miners. And then we'll wait and see which one's the winners. Like these list of people here, I expect every company here, I do a high alpha. That's what I'm after. All of these companies that I have invited are all 10 baggers at higher gold prices. They all have that kind of leverage. I don't know which one's going to be a 10 bagger. I don't know which one's going to be a 20 bagger. We'll wait and see which ones pan out. But I don't try to pick winners. I just try to pick very good companies that have a lot of potential. And then we'll just wait and see who the winners are. And I always say, I see so many people that try to pick winners. You never know who your winner is going to be. It's always going to be a surprise. Okay, the last one is exploration companies. And I'm a stickler for exploration. And the reason why is because the risk reward is not as good as producers or developers. So what I've done is I've broken it down just to 2 rules. And if they don't follow the 2 rules, I pass. The first rule is the gold and silver in the ground needs to be valued significantly below market value. These are called optionality plays. So I want to find companies that are valued at 1% or spot or less. So right now we have $5,000 gold. So 1% of spot would be $50 an ounce in the ground for gold. You can do the same thing for silver. I go a little higher for silver because they're rarer. But I want to find companies that are like 0.5% of spot. And believe it or not, they still exist today. I remember it wasn't too long ago. I've done several videos on optionality plays. And it was unbelievable how many of these companies were just valued at ridiculous valuations below $10 an ounce in the ground. And today, believe it or not, there's still a lot of, I haven't done an optionality video in a few months because there's not as many, it's not as juicy as it was, but there's still a few of them. But this is my first rule, is it a good optionality play? Because optionality plays in this market, in the bull market, all you have to do is kind of buy it, sit back and wait to get paid, because it's just a matter of time before the rising tide is going to lift the valuation to a market rate. And so these companies are going to go up 2x, 3x, 4x. I remember Banyan Gold was trading at $8 an ounce in the ground. I'm like, this is just ridiculous. And now it's up to about $50 in the ground. So it's like, 5x off its bottom. And so it was like easy money. It was a 5x, 5x just sitting there waiting to be taken. And we see these, I've seen this over and over again where these companies are mispriced. And so you can take advantage of the mispricing. One of my favorite stories is Lahontan. Victoria Gold went bankrupt, and Victoria Gold owned 30% of Lahontan. And I didn't own Lahontan because it was an under 2 million ounce deposit. And I'm not really excited. I want a little bit bigger deposit. But it was priced at, I don't know, it was really cheap before Victoria went bankrupt. And then Victoria goes bankrupt and they have to sell 30% of their shares. So Lahontan's stock just started going down, down, down. And it was like, it got so ridiculous. Their valuation got all the way down to $6 million. Totally mispriced. It was just absolutely ridiculous. So I bought it at the bottom at 2 cents. Now it's at 125 million, heading to 2 billion. So it was at $6 million, and the market didn't even realize it's a $2 billion company. Unbelievable. Next rule is the Lassonde curve. If a company is early in the Lassonde curve and has an excellent discovery hole, it passes one of my rules. So the Lassonde curve is the share price. So Lassonde curve, it starts at the bottom and it goes up. So when you want to buy at the bottom of the Lassonde curve, that means it's a very cheap stock. Very, very cheap. You're at the very bottom. That means the market cap is probably going to be under $35 million. And then they have an excellent drill hole. Those are beautiful, beautiful stories, but they're rare. There's only about 2-3 of them a year that basically fit that rule number 2. But when they happen, jump on it because it's easy money. The thing that's beautiful about it is exploration stocks are inelastic. That's one of the reasons why you want to kind of avoid them in a bull market, because producers and developers are highly elastic to the gold price, whereas explorers are not. You can own an explorer company, gold and silver price can go up, but the explorers, they got to find more gold. So the excellent drill hole, so it's early in the Lassonde curve, and I created this drill chart. You can use it for whenever you read any drill results on a news release. So I use grams per ton. If somebody comes out with an excellent drill hole, you see my little green arrow there, the gram meter hole is over 200. So you basically multiply the grams per ton by the meters, and it's over 200. That's an excellent hole. If it's below 50, I don't really get excited. Those are really marginal. Anything below 35, it's not exciting at all. But above 50 is a good hole. And then 1 to 100 to 200 is really good. And then above 200 is excellent. Above 500 is stellar. If a company comes out has a market cap of under 35 million and they come out with a stellar hole in a good location, that stock will jump 50% on that day. Those are rare. You don't see very many of those. A couple of those a year. 200 is the minimum. 2,000 for silver is the minimum. So you don't get super excited at 200, but if you get one that's like 300, 3,000, those are good. So those make a lot of sense. Now, since I have 2 more minutes, so I'll go ahead and use it. On my drill chart, at the very bottom, it gives you the low marginal acceptable on the grade. So if they come out with, let's say they have a good hole, a gram meter hole of 50, then you can also look at the grade in tandem with it. So, was it, a good grade of 50? So, 5 grams. So if you do a really good grade, underground 5 grams or surface 1 gram, and it's over 50, that's a pretty good hole. You kind of pay attention. I do this on a daily basis, and what I'm looking for on a daily basis is a gram meter of 75. Anything below 75, I kind of ignore. Anything at 75 with decent grade, that gets my attention, and I basically track it, and I share it with people, because any company that's hitting those type of holes, they're adding ounces in the ground, and if it's a developer or if it's a producer, then those ounces are going to turn into value. It's going to turn into money, if you will. And so, a little extra there. So that's it. We'll end it there.